All right, class. Today we'll finish chapter 3. So you can think of this is the class for June 30. Okay. So far we have finished until turnover ratios or efficiency ratios. Now we'll start today profitability ratios. So profitability ratio is one of the most important category of ratio analysis because it actually gives you the idea how much profit the company is generating from the sales of our asset investments or equity investments. So basically, there are three different proxies we can use for profitability measures. The profit margin or net profit margin. So when you say profit, it's basically net profit. Return on assets, return on equity, okay? So for the formula is here, net income scaled by sales. You can interpret by producing $100 worth of sales, the company is finally able to generate a profit of $17. Return on assets. You can interpret by investing in $100 of assets, the company is able to generate a $15 of profit. Return on equity. You can interpret by investing $100 in equity, the company is able to generate $32 of profit. So these are some proxies that actually helps you to identify the profitability of the company, and it is always recommended higher the profit, the company is performing better. Now, market value measures. So basically, these are some proxies that will give you some idea of what is the value of this company, what is the value of this firm in the market, like from the investor's perspective. So before we jump on to this slide, so we actually need to understand or need to learn some common definitions. So let's say, when we say market price of firm, okay? So we basically mean market price of equity. So that basically represented by stock price in the market, stock price. If you go to if you go to Yahoo Finance or anywhere, let's say Yahoo Finance, okay. And let's say you just type in, let's say Apple. So the stock price of Apple is right now 177.77 cents. So this is the market value of the company Apple. This is the market value of equity. This is the stock price, same thing. Now, some more cautions. When you say market price of equity or market value of equity, okay, so we basically refer to total value, total. So let's say if there are, so the caution is, when you say market price of equity, most of the cases we mean total value, total price. On the other hand, when you say stock price, we actually refer to stock price per share. So right now I have shown you from Yahoo Finance, stock price of Apple is 177, right? That is basically per share basis, okay? Now, if we look at their, let's see, number of shares, we can find it or not. Okay, so their market cap is 2797 trillion, right? So basically, market cap is a function of stock price per share number of shares. So 2797 trillion, okay? We know that stock price per share is 177.77. So number of shares. Right? Number of shares. So the number of shares should be $2.797 divided by 177.177. So which is 0.01573 billion, or you can say 15.73 billion of shares. So what I'm trying to tell you, be careful when you say market value of the firm, market price of the firm, price of equity. We basically, most of the cases, we basically refer to market cap, which is total market value. What is market cap? Stock price per share or market price of equity per share times number of shares. So this is market cap, this is market price per share, number of shares. If we divide 2.797 trillion divided by this value, you will get 0.10157 trillion or 15.73 billion number of shares. So you have to be careful, okay? Same thing. But whether we're talking about in terms of total value or whether we are talking about in terms of per share, okay? So that's the difference we have to be careful about. Now moving back, this is one of the concepts we learned, okay? Now the second thing we have to talk about is what is then book value of firm? Book value of firm. Same thing, book value of equity. So when you say like this, we're talking about in terms of total value, not in terms of per share, okay? So basically the book value of firm or book value of equity is basically shareholders' equity from balance sheet, okay? If we go up, shareholders' equity. So that's basically book value of firm, book value of equity, but in terms of total value, okay? Not per share basis. If we divide this 2768 amount divided by number of shares of that corporation or firm, you will get book value of firm, book value of equity per share basis. So these are some concepts we need to learn. So now we know what is market value of equity, what is book value of equity, right? Similar concepts. If you talk about market value of assets, book value of assets, similar concept, okay? But be careful, equity versus assets. Now, if we know these concepts, let's go back to that slide. So let's just assume the statements you're analyzing, the market price of this corporation is 87.65 per share, okay? Per share. Number of shares. So shares outstanding is basically number of shares available is 190.9. If you multiply these two values, 190.9 times 87.65, what are you gonna get? We're gonna get 16,714 million. That's the market value of equity or total market value of the firm or market capitalization, okay? So this is what we learned so far. So one of the most important proxy for market value measure is known as price to earnings. There are several proxy that you can use to measure market value. We can use them as a ratio for market value. One of them is price to earnings ratio. Now, what is price to earnings ratio? Also known as PE ratios. So price to earnings ratio is basically a ratio of price per share, which is stock price in the market. For this hypothetical example, 87.65, earnings per share, okay, which is net income divided by number of shares, net income divided by number of shares. So we got this information from here. Now for this information, we already talked about on the last video. So if you go here, total income, net income, profit divided by number of shares, which is around 190 point something, you're going to get 4.68. So price to earnings ratio is basically 18.73. Now, what is the interpretation? So the interpretation is to earn $1 of income per share, to generate $1 of profit per share, you have to invest $18 in the firm. So that's the interpretation. Now, whether this 18.73 is a good number or bad, so we have to be careful. So P is the most widely used ratios, and it has a lot of different explanations, so we have to be careful. So now, what are some care we have to use? So when you want to use PE ratio to talk about the value of any firm, of the valuation of any firm, we have to be careful. We have to compare the PE of the firm with a very similar firm. Let's say talk about two similar firms, Tesla and Rivian. If you go and search these two corporations, you will find that they are both electric vehicle manufacturing companies. In that case, you can only compare the PE of Tesla with similar electric vehicle manufacturing companies, but don't compare PE of Tesla with some other firms. Let's say Walmart, let's say Costco. No, don't do that. Okay, don't do that. So if you compare PE of similar firms, similar industry, similar firms, that means higher the PE ratio, that firm is overvalued. What does it mean? So when you say overvalued, that means this firm is expensive as compared to fair value. So what is a fair value? You can think about fair value. You can measure the fair value by book value of equity. That's a proxy. We're gonna talk about more about the fair value, okay? But right now you can think about one of the good proxy for the fair value could be book value of equity. So if you compare two different firms, one having higher PE than the other one, and they're similar, comparable, because they do same business. If one has higher PE, that means this firm is expensive, this firm is overvalued, so do not invest on this firm. On the other hand, if another firm has lower PE, that means they're undervalued, okay? As compared to the fair value, they are cheap, they're undervalued, so you can invest on that company. Now, on an average, if you want to compare PE across different companies, different industries, so let's say if you want to compare PE of Tesla with Walmart, Tesla will always have higher PE than Walmart. So when you compare PE of same one firm with different industry firm, higher the PE means growth firms. So basically, it is assumed that Walmart gives us consumer goods, like those are not mostly luxury goods, those are like our regular goods. So these firms do not have growth features, okay? On the other hand, it is assumed that right now that our future is green energy. We have to rely on green energy, not traditional gas energy. So that's why we are thinking that Tesla has more growth in future years than Walmart. Okay, so when you just talk about PE, irrespective of similar firms, we just talk about PE of random companies. So one of the major interpretation is higher PE means growth opportunities are more there. But if we compare similar, because if you think about green energy is our future, we have to rely on EV, that means Tesla and Rivian have the similar growth opportunity, okay? In that case, if one is higher PE, that means that is overvalued and the other one is undervalued. But if we just talk about general PE across different companies, higher PE means growth firms, lower PE means value firms. Value firms means these are some companies that do not have a lot of growth opportunities in the going forward. They basically mostly do sustainable business. Okay, so this is how you should interpret PE. Now, one of the things is that for most of the corporations, earnings could be negative. Earnings could be negative. If this is true, PE is also negative. In that case, it is called PE is not meaningful. We cannot use PE. If earnings is negative, price to earnings ratio comes out as negative. That's not meaningful. So we cannot use PE. What we can do? What we can do? In those regards, we have to think about other ratios. Sometimes we can do price to sales ratio, same interpretation, same thing, price to sales ratio, but sales cannot be negative, okay? We can do price to book value of equity, okay? Book value of equity, most of the cases cannot be negative. It's really, really unlikely that book value of equity could be negative. So we can do these things, okay? Now moving on, more discussion to price to earnings ratio. If we flip upside down, price to earnings ratio will become E over P, right? This ratio is known as earnings yield. What is the interpretation of earnings yield? By investing $1, how much income we can generate from this farm. Higher the earnings yield, it's better. Make sense? Any questions, confusion, feel free to shoot me an email. Now, another proxy, another market value measure proxy is EV to EBITDA ratio. So basically, EV means enterprise value over EBITDA ratio. So EBITDA is basically, if you look carefully, earnings before interest, tax, depreciation, amortization. So you know what is EBIT, right? If you add depreciation, amortization with EBIT, you're going to get EBITDA, okay? Now, what is enterprise value? This is the formula. Market value of stock, which we coming from here, 8765 times 109. Right? 16,732. Book value to liabilities, we'll get it from balance sheet, cash, get it from balance sheet. So this is enterprise value, okay? And if you do EBIT plus depreciation, EBITDA. So EBITDA is a proxy of operating profit, okay? It's a kind of proxy of operating profit. So you can say to generate $1 of operating profit, how much you're investing in farm, okay? So that's basically the farm value. So similar interpretation like price to earnings ratio. So these are two used proxies to measure market value, but price to earnings is the most widely used if earnings is not negative. So that's the key concept. Now let's do some sample questions. Let's talk about this. A farm has a total debt of 1,500, debt equity ratio of 0.25. What is the value of total asset, right? Now, what is given? So the given thing is debt slash equity is 0.25, which means like this, right? You can think about from here, you have 4 times debt, okay? So you can think about like 4 times of the debt is basically equity. So your equity value is basically 4 times of the debt value, right? So that means if you have $1 of debt, you have $4 of equity, right? Because equity value is 4 times larger, bigger of the debt value. Now, debt value is given as 1,500 times 4. So that is basically your Equity? 6,000? Make sense? We know that asset is a function of debt plus equity. So that means, make sense? So the total asset is 7,500. Now let's do this one, cash coverage ratio. If you go above and read the formula, I think the cash coverage ratio, let's say it CCR, cash coverage ratio is a function of EBITDA divided by interest, right? So EBIT is basically EBIT plus depreciation and amortization. So EBIT is basically sales 5,000 minus cost minus depreciation. But you have to add back depreciation, right? So that means this one doesn't make any sense anymore. So EBIT plus depreciation and amortization. So until this point is basically EBIT plus depreciation amortization. This doesn't make any sense anymore. EBITDA divided by interest expense, which is 250. So basically it is 2,400 divided by 250. And that should be, I believe, 9.6. Please do those practices. These are some good practice for you exam or midterm one. Okay. Let me know if you have any questions. More sample questions. Okay. How long does it take to sell inventory? Okay. So think about the formula. It's asking in terms of day. So we have to think about inventory turnover first, and then you have to think about number of days needed, right? So you can come here, inventory turnover, and days sales in inventory, right? So cost of goods sold divided by inventory, then 365 divided by inventory turnover, right? Pretty easy. So I'm just saying IT as inventory turnover, okay? So cost of goods sold is basically 1240 divided by cost of goods sold inventory. So cost of goods sold divided by inventory, it should be 400, right? 3.1. Now days, if you want to convert in terms of days, so it should be 365 divided by 3.1, that should be 117.74. So my recommendation, whenever you can see some sample questions, pause the video, try it by yourself. Then match with me what I'm doing, okay? Don't just look at me what I'm doing. Pause the video, try it by yourself, then match with me. That will help you to learn. If you make any error, it'll help you to learn why you made the error, okay? So I always recommend that it's good you make the error right now, so that you are not making error on the exam. Because if you're making error on the exam, that is expensive. Making error today is not expensive. So make sure, pause the video, do it by yourself, then match with me, okay? Now let's do some DuPont identity. So basically I told you one of the most important measures is profitability. And out of the three proxies, this is the most important proxy. Net income over total equity, return on equity. So basically, DuPont measures basically extended this equation. So if we look carefully, if we start with this equation, this one basically means 1, right? Total asset over total asset is basically 1, right? And we know that anything multiplied by 1 is the same thing. There's no changes. In that case, if we multiply or extend the equation, there is no changes. Now we just rearrange the equation, okay? What we did, net income divided by this total asset, and then this total asset divided by total equity. Same thing, we just rearrange, no problem. Now, if you look carefully, this is return on asset. This is what? Equity multiplier, total asset over total equity multiplier, okay? Now, what we're trying to do, rearranging again, because this is a 1. Anything multiplied with 1 is the same thing. Rearrange, what is that? Net profit margin or profit margin. What is that? Total asset turnover. What is that? Equity multiplier. You can think that we extended return on equity is a function of profit margin, total asset turnover, earnings multiplier. Sorry, equity multiplier, not earnings multiplier, equity multiplier. So return on equity is a function of 3 things: profit margin, total asset turnover, equity multiplier. So now, if you want to decompose, if you want to dig deep about what causing better profitability, we can look at these 3 functions. And then we can think of what causing better profitability. Now let's talk about this example. So this is basically some real data of Yahoo Finance and Alphabet. Alphabet means Google. Now, if we compare 2013 of Yahoo Finance with 2013 of Alphabet, you can see that return on equity in 2013 is better for Alphabet, okay? Although the profit margin is better for Yahoo Finance, because Yahoo Finance generated, by selling $100, Yahoo Finance generated $29 net profit. On the other hand, Alphabet, by selling $100, generated only $21 net profit. But this is the difference maker, because you can see that equity multiplier is almost the same thing, almost the same thing. This is the difference maker, because Alphabet is making better usage of asset. So they're efficient in turning over the asset. So they have a better asset turnover than Yahoo Finance. That's why the profit is better. So ideally, these 3 components have impact or influence on the final return equity. If you have better profit margin, better efficiency in asset management, which is total asset turnover, and if you have higher equity multiplier, you should have more profitability. Now, profit margin and asset turnover is basically your efficiency, right? On the other hand, equity multiplier is not efficiency. You can issue more debt and you can raise the equity multiplier. So let's say you can decide, I will use only my money to the business. On that case, equity multiplier is 1, okay? On that case, if you decide you will use your own money and do not borrow, your equity multiplier is 1. On the other hand, if you decide you use your own money and borrow a lot, your equity multiplier will be more. And you already learned that higher equity multiplier is able to generate more profit, right? So why not borrow more and generate more profit? There is a problem. Because if you borrow more, this borrowing comes with fixed burden, which is interest payment each year. Doesn't matter. It doesn't matter. You're making money or not. Your interest payment is fixed. That's a fixed burden. You have to pay it annually, okay? In that case, if you compare Yahoo Finance return equity here, equity here, okay? If you just compare, what are you gonna learn? So let's say equity multiplier is 1, okay? Equity multiplier is 1 for 3 situations. Now you guys calculate the new return on equity. Don't take it this value, just think 1. So if equity multiplier is 1, let's do the math here. Return on equity is basically minus 87.5% times 0.110 times 1. Because I assume equity multiplier is 1. So the value is 9.625% negative, okay? This is 2015. Now, if you compare 2013, for 2013, the value is 29.2 positive, 29.2, it is 279, and assume 1, 8.1468. Now let's compare with the real value. For 2015, if we assume equity multiplier is 1, your return equity should be negative 9%, 9.6%. Here, negative 15 is more odds, right? More odds. For 2013, if we assume equity multiplier is 1, you should have 8.14% of equity, return equity. Here, 10% is more better. So the thing is that borrowing or debt comes with interest burden. If you are really able to make positive profit margin, then higher debt is good for you. If you are not able to make positive profit margin, then higher debt is bad for you. So the idea is, if you're doing good business, or if you're having a good time, that means you're doing good business, making profit, positive profit, then borrowing is good. Borrowing is good because you will only share the fixed burden with them. You will not share the growth of your business with the bondholders or loan providers. On the other hand, if you are not sure whether you'll be able to make profit or not, so that means you have a bad time, your profit margin is negative, borrowing is not good for you. So the conclusion, in good time, more debt, more equity multiplier will make your situation better. In bad time, more debt, more equity multiplier will make your situation worse. So this is the understanding, okay? So if we want to make a short story about DuPont, it has 3 components. It helps you to understand which one is helping you to generate higher return equity. If 3 of them have higher values, you'll have more return on equity. And then in terms of these 2 values, these are your performance. You have less control on these 2 values. On the other hand, this is a decision to borrow or not. You have more control on this. You can decide, you can choose more borrowing or less borrowing. More borrowing is good only when, if you are sure you're able to make positive profit margin. But more borrowing is not good if you're making negative profit margin. Let me know if you have any questions or not. Now, so far what we did common size balance sheet, we did ratio analysis. And I already told you why we do so. We want to analyze the health of the corporation. We want to analyze the statement of the corporations. We can do 2 types of analysis. One is we can compare the same firm over time, which is called time trend analysis, or we can compare the same firm for 1 year with a comparable firm, a competitive firm, which is called peer group analysis. Okay, same firm. Okay, so these are the 2 reasons, like 2 similar firms, or same firm over different years. Same firm over different years, or for 1 year, we are comparing one firm with a similar firm. So these are the 2 reasons to see what's going on in the performance. But even if we do ratio, even if we do common size, there are some potential problems. Because if you can remember, when I was trying to interpret ratios, I'm trying to tell you there is no rule of thumb, but higher is better or lower is better, right? I'm trying to explain like this. So that's what it is. The problem is there is no underlying theory. It's more of a qualitative argument, qualitative explanations, okay? And now I'm also trying to tell you, like sometimes we want to compare a firm with a similar firm, right? But the problem is this benchmark sometimes is not available. Sometimes we do not find a similar firm. Because let's say Walmart, what do you say? It's a, what kind of store it is? It's a grocery store. It's a, what kind of store it is? It's a retailer. What is a good competitor of Walmart? Maybe Costco only, but Costco is a wholesale club like Sam's Club. So what is a good competitor of Walmart? Target. Could be Target, but Target don't have gas station, I believe, like Walmart has Murphy. So how should you find a similar firm? Even if you talk about Tesla, similar firm Rivian, but Rivian is more specialized on electric vehicle trucks. Tesla is more specialized on electric vehicle private cars, right? For private use, not corporate use, right? And Tesla is doing a lot of different things. They're doing satellite, they're doing a lot of different things, right? Sometimes it's tough to find a benchmark. Sometimes some firms have extraordinary events. It's tough to identify those and adjust those events. And sometimes similar firms follow different fiscal years. Let's say Tesla followed January to December as their fiscal year. Rivian could follow July to June as their fiscal year. Then it's tough to compare those values because they are running in different time. So these are some potential problems. And now we're going to wrap the class, but one final thing, like so far, we actually talked about simulated statements or hypothetical statements. Now, where you should find real statements, right? Please check SSC Edgar, you'll find real statements, Yahoo Finance, Google Finance, you'll find real statements. If you have any questions, any confusions, feel free to shoot me an email or set an appointment. So we're done with chapter 3. See you on the next lecture. Thank you. Bye.